Good morning, everybody, and welcome to Paycheck's second webinar of the year. Really pleased to be joined by Becky from our partners Chase de Vere, and she'll be going through the wonderful insights with you about salary exchange, which is a really popular topic with clients and companies at the moment. We actually do this a lot through our client base, and it's something else obviously has great advantages for people. So Becky will be happy to talk you through that. Thanks everybody for joining on what looks like it's going to be another glorious sunny day here in Battersea. So pleased to have you all on board. We will be doing questions at the end, so by all means, if you've got any questions we're going through, please just put those in the chat and we'll cover those off at the end. And we will be recording this session as well, so if there's anything you need to duck out or anything you missed at the beginning, don't worry, we'll be sharing that link later on. Okay, so without further ado, hand over to you, Becky.
Thank you, Mark. Morning, everybody, and welcome to this morning's session around salary exchange. My name is Rebecca Dorian and I'm a corporate advisor at Chase de Vere. So I specialise in advising businesses, employers on their employee benefit strategy, helping them comply with pensions legislation, and in this case, helping save money with salary exchange, which is a way to structure pension contributions. As Mark alluded to in his introduction, myself and my colleagues at Chase de Vere, we're all converting a lot of pension schemes over to a salary exchange basis, more than ever before, really. And salary exchange isn't something that's new. You might have heard of it before, or you might have heard of it called salary sacrifice. They're exactly the same thing. Salary exchange or salary sacrifice was around when I first qualified as a financial advisor back in the early 2000s. It is just currently more popular than ever because HMRC have been a lot clearer on the rules around salary exchange, and that's been the case for a number of years. But I think the main reason why it is so popular at the moment is that it's a great way to save money for your employees with the same pension contributions going into the pension plan, but also save money for you as employers, which, you know, you can use that money that you save to put back into the business, or you can use that money to spend on your employees in other ways. A lot of our clients are trying to find ways to, you know, increase salaries or provide additional benefits. So salary exchange is sometimes a nice way to be able to fund the cost of that without it costing the employer money, and also giving your employees something back in national insurance savings as well. So the agenda that we're going to cover today is shown on the screen here. I'm going to give you a brief introduction to Chase de Vere, which is the company that I work for. You may have come across Chase de Vere previously. We've been working with Paycheck now for a number of years, I think going right back to 2013. So you may have seen me or some of my colleagues on previous webinars, or had some support from Chase de Vere previously, but we've got a long-standing relationship with Paycheck, and we're really proud of that relationship and supporting each other's clients for such a long time. I'm going to talk about what salary exchange is and why it's so popular, and then I'm going to give you some examples on what the salary exchange savings could look like, because I think it's easy to talk about all of these technical terms when it comes to taxation, but salary exchange is really simple. And if we look at a worked example of somebody's salary, you can see pounds and pence what your employees might save if you decide to implement this, and also what you might save as an organisation as well. We'll talk about some of the things that you might want to consider if you do decide to implement salary exchange. And with Chase de Vere and with Paycheck as payroll, you know, you can be confident that we've implemented many salary exchange schemes, so we can give you the support that's needed there. And I'm going to give you some sort of key considerations, things that you might want to think about or discuss further at a later date. And then, as Mark said, there's time at the end for questions should you have anything that you want to clarify. So, Chase de Vere, we are the largest firm of independent financial advisors in the UK, and for all of the advisors at Chase de Vere, that independent status is really important to us. That means that if we're looking at your pension provider, or if we're looking at your private medical insurance provider or life insurance provider, whatever, you know, you've asked us to look at on your behalf, that means that we have access to the whole market, so we can go out and hopefully get you the best rate possible for you and for your employees. So we're really proud of that independent status, and it means we have to take extra qualifications, and it means that Chase de Vere have to complete additional compliance, but we're Chase de Vere are confident that that independent status will continue. So that's really, really important to us. We have two divisions of Chase de Vere, so the corporate division that I work for and the private client division as well, who would specialise in advising individuals. And you can see that we've won a number of industry awards and been around for a very long time, so established in 1969. All of that hopefully just gives you reassurance that with Paycheck, we're a trusted pair of hands for your company and for your employees as well. Okay, so salary exchange. So the main content of today's session, coming on to that, salary exchange in its most basic form is an agreement between you as the employer and your employee, where the employee agrees to exchange or sacrifice part of their salary, bonus, or even redundancy pay in some cases for an increased pension contribution. So your employees have an agreement with yourself as employer to say, don't pay me that £100 as salary, pay it to me as an additional employer contribution instead. Okay, and the advantage of having that agreement between yourself as employer and the employee is that £100 doesn't go through payroll, so it's not subject to income tax and it's not subject to employee national insurance or employer national insurance. Now, we know that with pensions, employees are able to claim income tax relief on their own contributions, so the position on that for an employee is neutral, but the extra benefit for the salary exchange for the employee is the national insurance saving. Salary exchange can be used for other non-cash benefits, such as employer provided pension advice, company cars, ultra low emission vehicles, workplace nurseries, cycle to work, childcare vouchers, that sort of thing. For the purpose of today's session, I am going to focus on pension contributions, but if you did want to discuss as part of an overall project implementing salary exchange for any of the other benefits that I've listed on that slide there, then I'd be happy to talk to you about those too. Okay, so it's popular because it's tax efficient for both employees and employers, and as I've already alluded in the introduction there, companies more than ever before are looking at ways to save money by reducing costs, and this is a really nice way to do that because you're not taking anything away from the employee. Actually, you're giving the employees the same pension contribution into their plan in most cases, and also extra money in their take-home pay with the national insurance saving. The administration for salary exchange is much simpler now. So HMRC have actually moved salary exchange for pensions onto an approved salary exchange list, which just means that there's a few less hoops that you have to jump through when you are implementing a salary exchange scheme to make it compliant in the eyes of HMRC. And HMRC have also confirmed that they're not auditing salary exchange schemes for pension anymore. So it's important that you cross the T's and dot the I's, of course it is, but that risk of HMRC storming in and saying you've done something wrong and we're going to claw back all of this tax is removed, and HMRC have confirmed that they're not auditing schemes, salary exchange schemes for pension anymore, because they are so commonplace and widely used, and there's clear guidance on what you need to do to set one of these up. So your saving that you make as employer with national insurance, you can take that saving and put it into profits. You can take that saving and increase pension contributions for employees. You can take that saving and offset against any costs for implementing the salary exchange, or you could use that as a way to maybe pay for additional benefits that you've been thinking of introducing for a long time. So we have a lot of clients now, because of the NHS at the moment, and because they're finding that employees are finding it increasingly difficult to get treatment under the NHS because waiting lists are getting longer and longer, that employers are increasingly looking at some form of medical benefit for their employees. Not only does that have the benefit of keeping your employees happy, getting them back to work quicker if they've got an illness or an injury, but it has the benefit of keeping your employees happy and within your organisation. So retaining your employees because you provide them with a comprehensive package that if they went outside of your organisation, they perhaps wouldn't get that level of support or coverage. So lots of ideas, things you could do with the money that you save as employer. You might already have an idea of what you might do with the saving, but if you want to discuss anything that might be relevant to your company, then please do let me know, and I'm happy to pick up on individual conversations following today's session as well. We've got a whole ream of benchmarking information that we can share, so if you're interested to learn maybe what other companies in your sector provide by way of employee benefits, I can share that with you easily following today's session as well. Okay, so when we've clarified when we're talking about salary exchange that this is a national insurance saving, which is a tax that employees pay, they have automatically deducted from their salary, and also that employers pay in respect of an employee's salary. So what I'm going to do before I start talking about numbers and facts and figures is just outline some of the limits and thresholds that apply to national insurance contributions. So we have a primary threshold for national insurance, which I've abbreviated there as PT, an upper earnings limit, which is I've put on the slide as the UEL, and a secondary threshold, which is ST. Now, the primary threshold in this tax year is 12,570. The upper earnings limit is 50,270 a year, and the secondary threshold 9,100. Okay, so the national insurance rates, depending on whether you're an employee or an employer, will depend on those limits and how your salary falls within or above those limits. So employees will pay 12% national insurance on all of their earnings, on their earnings above the primary threshold of 12,570 and up to the upper earnings limit of 50,270. Any earnings above the upper earnings limit, so anything above 50,270, an employee will pay national insurance at a rate of 2%. Employers pay 13.8% national insurance tax on all earnings above the secondary threshold, so above the 9,100. Okay, and those limits, the primary threshold, upper earnings limit, and the secondary threshold, the 2023 and 24 rates are exactly the same as the 22-23 rate. So the government kept those exactly the same, and in a climate of rising prices, that's tantamount to a tax increase, because usually year on year those thresholds increase, so the amount that we need to earn before we start paying taxes increases. Because those were frozen and kept at the 2022-2003 rates, that just makes salary exchange even more important as a way of saving tax, to try and negate some of that effective tax increase by freezing those limits. Okay, salary exchange in picture form, again, just to help bring this to life. So if an employee directs their national insurance savings into salary, increasing net pay, the bar charts here just show you what that would look like. So before salary exchange, they have take-home pay, income tax, national insurance, and pension contributions shown there. What happens after the salary exchange is that their take-home pay is increased. That's why the bar chart there is larger. Their income tax position is neutral, because they can claim that whether it's salary exchange or not via the pension contribution. But you can see there their national insurance contribution has been squeezed, and the increase in the take-home pay reflects the amount that national insurance contribution has been squeezed there. And again, the bar chart just demonstrates that the pension contribution before salary exchange and after salary exchange is exactly the same. The difference is more in an employee's pocket, less in national insurance. So the employee agrees to exchange or reduce their salary by an amount equal to their gross annual pension contribution. In exchange for that, the employer agrees to pay that amount into the employee's pension instead of through salary. So if you had a pension scheme at the moment where the employer paid 4% of basic pay and the employee paid 4% of basic pay, the employee agrees to reduce their pre-tax salary by 4%, and exchange it for an additional employer contribution of the same amount. So the employer will, following the salary exchange, actually pay an employer contribution of 8% into the pension plan, and the employee's pre-tax salary is reduced by 4% to fund half of that. Okay. Total pension contributions remain unchanged, and the employee's saving is directed to their net pay. A point of note there, if you do have any other employee benefits that are based on salary, some companies provide life insurance, for example, to employees, which would be a benefit basis of 4 times salary. If you do implement salary exchange, it's just really important that you let the life insurance provider or income protection insurance provider know that you're now paying contributions on a salary exchange basis. That means that by introducing the salary exchange, the employees won't be worse off in the event of their death, because the life insurance provider will base the benefit on their pre-salary exchange salary. Very simple, straightforward, and because this is commonplace, you won't have any problem with the insurance providers on that, but just a point of note on that slide, really. Okay, so moving on to a worked example. So just trying to bring the salary exchange to life a little bit here, and I've used an employee's salary of £30,000 a year, and I've assumed a 5% employee pension contribution and a 3% employer pension contribution based on basic pay. So before salary exchange, this individual earns 30,000 gross. They pay £3,486 a year in income tax. They pay £2,091.60 a year in national insurance. Their contribution, their personal contribution, would be deducted net of basic rate tax. That's how largely non-salary exchange pensions work. So the employee pension contribution that they would then have deducted and see on their pay slip in print in pounds and pence amount would be £1,200 a year, meaning that once we've taken all of those deductions, their net salary £23,222.40. Okay, the employer will pay £900 into their pension plan, and the employer will pay national insurance of £2,884.20 a year. So the total contribution into that individual's plan on a non-salary exchange basis is £2,400, which is £1,200 employee net contribution, £900 from the employer, and then the balance of that in income tax, which the pension provider reclaims. If somebody's a higher rate taxpayer and they've paid additional taxes above the basic rate 20% income tax, then it's their responsibility to reclaim that themselves. And you wouldn't probably be surprised to learn that when we implement these salary exchange schemes, we come across a lot of higher rate taxpayers who weren't aware that they needed to reclaim their additional tax release themselves via their self-assessment tax returns. So that quite often comes as a surprise. There are things that we can do to help with historic tax reclaims, so it's not all doom and gloom, but I think a lot of employees assume, especially now because automatic enrolment has taken away some of the initial choice. I think the general assumption for employees is that, you know, the tax position's all sorted out for them as well. But on a non-salary exchange pension, if you're a higher rate or an additional rate taxpayer, it's your responsibility to claim that additional income tax yourself. Now, salary exchange, while the income tax position is neutral, higher rate taxpayers and additional rate taxpayers find that they have an administrative benefit because they've no longer got to declare any additional tax reclaim on a tax return, and sometimes avoid the need to complete a tax return altogether. I digressed slightly, apologies. So we've been through the before salary exchange column. So after salary exchange, then what this individual does is, instead of taking that pension contribution as salary, paying tax on it, paying it in, reclaiming the tax back, they reduce their taxable salary by the amount that they want to pay into the pension. So in this case, by £1,500. So the amount of salary that's now subject to tax, instead of being £30,000 a year, is now £28,500. The income tax that's shown on their payslip is reduced, £3,186. and the employee national insurance that they pay is reduced. So instead of 2091, it's now 1911 a year. Their pension contribution reduces, so they no longer pay personal contributions into the plan, but their net salary increases by £180 a year. So they now earn £23,402.40. The employer pension contribution goes up because of the salary exchange. So the employer pension contribution is now the 2,400, and you can see there the employer national insurance tax also decreases. So that's now 2,720, a saving of 164.20, but the amount into the pension for the employee in both examples is the same, 2,400. So by implementing salary exchange for this example here, the employee has saved £180 a year and the employer has saved 164.20 a year, and that is an annual saving. So both employee and employer save that every year. Okay, hopefully that example was clear and just helped to bring the mechanism of salary exchange to life. If you wanted as an organisation to work out what your employer's salary exchange saving might look like, then I'd be happy to support you with that, and there'd be no fee or charge involved with supporting you with that calculation. What we do have to be careful with, because we're then sort of discussing employee sensitive information, is just that we be sensitive to GDPR requirements. So if you want that calculation, do reach out. I'll reassure you on the GDPR element of sharing sensitive information, and I'll work out what that salary exchange savings is likely to be for you as a group, and that will help you decide whether you want to take things forwards. Okay, so moving on to considerations. We've already covered this off slightly, but reducing an individual's salary might affect other salary related benefits. So as part of an implementation plan, we would do a fact find exercise with you where we'd gather whether you had any other salary related benefits where we needed to let the insurance company know, and then that sort of crosses off that as an objection to implementing the salary exchange. It might impact on employee borrowing levels. So if you do have employees who are looking to obtain a mortgage or obtain any other form of borrowing, obviously the credit provider is going to take their salary into account to work out affordability. When we communicate salary exchange, we do provide a frequently asked questions document to employees, which has got, you know, examples of pre and post salary exchange pay slips and all of the key information salary exchange in there. And on the back of that frequently asked questions document, it does say, will salary exchange affect my ability to borrow and take out a mortgage? And, you know, the short answer to that question is it possibly will. But the much longer answer to that question, and it is clarified in the frequently asked questions document, that in practice it doesn't, because salary exchange is such a popular benefit now, and it's not just operated on pensions. I haven't in my 20 years come across a credit provider who's had an issue with using pre-salary exchange salary as you know, the salary that they use to work out affordability for borrowing, etc. But if you do come across any provider with any of your colleagues, then we do have a letter template which we can share with you as employer, which you can share with your employee, which just confirms formally the pre-salary exchange salary, and that should again alleviate any problems. So I guess as I say, the short answer to that question is possibly, but in practical sense it doesn't affect, and that would only be an issue where somebody was looking to borrow that, you know, the maximum mortgage based on their salary anyway. But if we're having conversations with employees and their salary exchange makes them nervous because, you know, they're in the process of buying a house, then it's really simple to reassure the employees on the salary exchange. Just have them opt out of the salary exchange until the house purchase is completed, and then pop them into the salary exchange after. You have the flexibility to offer that to your employees anyway. The salary exchange might not be suitable for those who are close to or below the tax-free personal allowance of 12,570. We would cover that off within project planning, and we would set a pay protection limit for your employees anyway, to avoid any employees being negatively impacted via their tax status, via their accrual of certain state benefits. And also you want to make sure as an employer that you don't impact any national minimum wage legislation. So that would all be incorporated as part of the project plan to make sure that there's steps in place to make sure that that doesn't negatively impact the launch of the salary exchange. Paycheck would support you with keeping a notional pre-salary exchange salary figure to base, you know, all of your benefits on, if you're paying overtime, if you're working out redundancy payments, that sort of thing. And the pay protection limit I've already mentioned, but we'd incorporate that as part of the project planning. But that's to protect you as employer and also the employees, to make sure that the salary exchange is as beneficial as it possibly can be. So if you decide, you know, following today's session, that you do want to introduce salary exchange to your employees and you'd like to investigate whether Chase de Vere might be able to support you with that, the first sort of stage of that process would be to run that cost analysis, just to see how much you, and if you're interested, your employees might save as a result of implementing the salary exchange. And then we'll provide an implementation plan and a recommendation so that you've got a clear process. We'll provide salary exchange announcement notices for employees, and that will help you with the communication. And we can, subject to the size of your organisation and, you know, any sort of communication strategies that you adopt as an organisation, but we can deliver staff webinars, presentations, and provide question and answer documents. So it depends on how you feel is the best way to communicate with your employees. We can work with you to explain how to use your savings in the best way, and provide advice to all of your business needs in that sense, and help you implement the adjustments to any other salary related benefits so that they're based on the correct salary figure and you're implementing the salary exchange in the most effective way. Importantly, what we will also do is work with you to make sure that the implementation of salary exchange is compliant with automatic enrolment pensions legislation. So at the moment, you know, because you're required to by legislation, you're automatically putting your colleagues into a qualifying workplace pension scheme, providing they meet certain criteria. What you want to do is to make sure that the salary exchange fits in nicely with processes and procedures and doesn't mean that you fall foul of any of the legislative requirements upon you for the automatic enrolment legislation. The best way to do that is to also have a default position for the salary exchange. So at the moment, you're telling your employees when you will automatically enrol them, and also how much you're going to take from their salary and where you're going to invest that money and with which pension provider. What you'll also do is add a further an extra step into the auto enrolment journey and tell your employees, if you earn above the pay protection limit, which will help you work out, if you earn above the pay protection limit, the default position will be that your contributions will also be paid on a salary exchange basis. And then all of the communication piece that we'll provide to you for existing staff and then for new joiners that follow will give the employees further information on salary exchange and give them the opportunity to opt out of the salary exchange if they wish. In practice, you won't get hardly any, if any at all, opt-outs of the salary exchange. Most employees are happy with the same pension contribution into their plan and the increase in take-home pay. So same benefit, but costs them less in a nutshell. Communication is key to a successful launch, so you would want to make sure that this is not viewed negatively by your employees, and we can support with that based on however you feel is best to communicate with your employees. So is salary exchange a win-win for all? We certainly think so at Chase de Vere, and I think that's why it's so popular across the industry. Employees reduce national insurance, employees can increase their net pay, so to help with the cost of living crisis. You'll reduce your national insurance cost, which you can use to then spend on other things if you wish. It can help as well re-engage with pension planning. It might have been a while since anybody's spoken to your employees about the company pension scheme. So if you decide to appoint Chase de Vere to help you with the salary exchange and help communicate and launch that with your employees, what we will also do is do a small piece around educating your employees, reminding your employees, you know, what is the pension scheme? How does it work? What do they do with their contributions? How are they invested? And those sessions do go down really well to help drive engagement within the business and help sort of reinforce the cost of your employer spend. And Chase de Vere and Paycheck will help you all of the way throughout that process. Now, Chase de Vere would produce a service agreement with you if you decided to appoint us, which you can consider before you hit the button and decide to move forwards with salary exchange. And in the interest of being open and honest, there would be a fee for Chase de Vere's services for the implementation and communication of the salary exchange, depending on how we structured that project with you. But we'll always be clear on what that fee is and exactly what's covered by that fee, so that you can decide whether you want to take advantage of all of those services or not. And in 99.9% of the time, the employer saving that's generated by implementing the national insurance more than covers our fee for the implementation. And a lot of the work that we do will be the one-off stuff. The regular annual reviews of the salary exchange are much less onerous, so that will all be very clear. There also is a small charge from Paycheck or your payroll provider to convert the payroll over to salary exchange, and Paycheck will discuss all of that with you at the time. But again, in the interest of being open and honest, you'll consider all of that as part of the project review. If you want further information on salary exchange, obviously, reach out to me. I've got brochures, newsletters, further information. We can have a chat about the specifics in relation to your business. But if you wanted to look at some impartial government-sponsored links to reassure you on salary exchange, the mechanisms, process, etc., then I've put a couple of links on the page here, and we can circulate those following today's session if anybody wants to take note of those links. Just our important information slide there, so disclaimers, risk warnings. As you'll appreciate, being regulated by the FCA, obviously it's important that we're very clear and open and honest on everything that we talk about today. But that's the end of sort of my information session on salary exchange, and hopefully there were some useful snippets in that session, things that you can take away from today, food for thought. Does anybody have any questions, anything that they might like me to clarify in today's session? Just while you're thinking, if you have any questions, I'll also just mention that if you did want to have a conversation with me directly, I guess the best way to do that would be to go via Paycheck, as they've hosted and set up the session today, and then they can coordinate responses. So do reach out to Paycheck directly, and then they can forward any inquiries to me from an advice implementation process perspective, and Paycheck will be able to deal with any inquiries from a payroll and tax process situation. So I can't see any questions have come in as yet. Mark, can you?
No, that's absolutely fine. No questions yet. So yeah, that was really informative. Thanks very much, Becky. It's kind of nice to have that benefit is something that's going to benefit employees and employers, which is a rare thing these days. Isabella, head of our marketing team, is going to be posting up shortly on the chat a little link to a survey just to give us some feedback about that session, and also to get some ideas from you on future sessions that you may find useful. Becky's got a wealth of experience with We've also got other topics we're looking to launch out later on in the year. Obviously, the more information we can provide for you, the better. So please make sure you complete that survey. Like I say, if you did have to drop out for whatever reason, don't panic. This is going to be available for you in a recording. And yes, please do follow us on LinkedIn. So follow Paycheck, myself, and Becky on LinkedIn as well. Yeah, and if you've got any questions, then by all means come through. Or you just had a question from Joanne. If employee national insurance contributions reduced, how does this affect them reaching the minimum national insurance contributions to qualify for full government pension?
Thanks, Joanne. That's a good question. So the pay protection limit that we will help you introduce will avoid employees falling foul of exactly that scenario there. So to qualify for a year of the basic state pension, an employee needs to earn above the lower earnings limit, which wasn't on that national insurance slide, but the lower earnings limit is around about £6,240. So as long as an employee earns above that level for a qualifying tax year, then they'll earn a year's worth of state pension. And if they earn above that level for 35 or more years, then they'll get the maximum basic state pension. Salary exchange won't impact that because you're not going to allow any employee to exchange their salary below the pay protection limit. And the pay protection limit for most employers would be around about 24,000 of salary, like a full-time equivalent salary. But it just depends on how your wages are structured. So yeah, there's protections in place to make sure that state benefits are not adversely impacted by the salary exchange.
Brilliant, thank you. So Isabella, I can see has just left the link in the chat there. So like I said, please do complete that. If you're not already a Paycheck client, then by all means reach out to me. I'll be happy to have a chat with you about benchmarking your current provision against what Paycheck can offer you. And equally, like Becky said, if you've got any questions, please channel those for us as well. And we're happy to pass those on to Becky in turn. So I'll give you time back to your day. There's no further questions. And I'm going to go and chase down an ice cream van if I can. So yeah, have a lovely day for the rest of the day, and we'll speak all again soon. Thanks very much. Take care.
Thank you.
Bye.
Bye.